quick word on the road ahead before I hand it over to the next team. So while we won't cover all this today, I think now we have a reasonably vast product suite that spans funds in the fundamental investing, whether it's your all cap funds, your mid and small cap funds, or your thematic funds, funds in the factor space, funds in the passive space, solutions in the fixed income space, including tax efficient fixed income ideas, and a whole suite of other offerings on the international and precious metals side. I won't go through all of this, but as we go through the course of the day, we'll of course spend time on our core offerings. If you have any questions on anything that is not covered in the session, we have a Q&A towards the end of the session to talk about any of the offerings on this platform, and we're more than happy to answer questions. Some of you also would have seen that SEBI has announced the launch of specialized investment funds. And I wanted to take a couple of minutes to talk about this because I think it will be relevant for investors. Today, if you look at investment platforms, you have the mutual fund platform, which has vanilla products for all kinds of investors, with of course a set of investment restrictions. Then you have the AIF and PMS platform, which are SEBI regulated platforms, which allow you a lot more investment flexibility, but they are meant for a larger starting ticket size, typically 50 lakhs or 1 crore. SIF is a platform that aims to bring the best of what is mutual fund and AIF and PMS to the consumer. The SIFs have to have a different brand. So we will be launching our specialized investment funds under the brand Altiva SIF by Edelweiss Mutual Fund. We do think it's a very, very compelling opportunity. You will have the comfort of the MF platform, the taxation treatment of the MF platform, but some of the flexibility that the PMS and AIF platform offer you at a starting ticket size of 10 lakhs. So for more evolved investors, you'll keep hearing from us. There'll be a lot more to offer on this platform, and we do think it could be very large. The last thing I'll say is, most of you who are here are investors through our domestic business on the mutual fund side, but we've also seen from you, family, friends, interest in investing in Indian solutions from investors who are overseas. We now will have our presence and products on the GIFT platform out of Gandhinagar. All of you, I think, will be familiar with GIFT, otherwise I'm happy to answer questions. But for international investors who want to buy an Edelweiss Balanced Advantage Fund or an Edelweiss Flexi Cap Fund, we will be having structures in GIFT where you can invest money in dollars that comes into these funds. We also will be creating opportunities for local investors based here who want to send money abroad and invest in a China fund or any other international funds, given limits are restricted in India in dollars. So those opportunities on GIFT will be coming up. So existing funds, perhaps some new launches this year, and our GIFT offerings and our SIF offerings, that's what ahead of us. I'm going to stop right there, and again, thank all of you for the tremendous support and participation that you've given us and our company over the last year. I look forward to engaging with you through the course of the evening, and we'll hand it over to our fund management team to talk about markets and money. Thank you.
Thank you very much, Radhika, for setting the tone. And I'm sure all of us are very excited to see what lies ahead of us. But before that, 2025 has been full of surprises for us, right? This is something as investors, all of us will agree that there has been no shortage of headlines, right? So I'm sure a lot of us have been unnerved about the markets. So before we move ahead, can we take another pulse on the markets, shall we? So can you please again go to your phones and scan the QR code or menti.com and enter the code there? You can switch on your cameras, scan the code, and then go to menti.com. Shall we check the results? Very interesting. We see mostly bullish. Markets have more steam. So a lot of faith in India domestic markets, I see. Well, quite a few people moving towards neutral and waiting for clarity as well. So fantastic. I think for our next speaker, it's going to be a tough one, moving from being bullish to neutral. So it gives me a perfect chance to call on our next speaker, our CIO, Pradeep Bhattacharya.
Thank you. Good evening, everyone. And as Radhika started, I can't start without thanking you for giving us your capital to manage. Hopefully, we have done a decent and good job at it. Our attempt has been certainly there, and we hope to do it in the future. With that, let me start by saying, I mean, there are enough number of investors who have come and talked about the fact that investing is simple but not easy. So what do they mean, and what do I mean by that? So over the next few slides, I will take you through three parts. One, why is it simple, which describes the process. Why is it not so easy? Has it been, what are we talking about to make it more easy in times when people are losing their head, as she talked about the volatility. And finally, a scorecard on how our funds have done. Let's get started. When people are losing their head out because of the various headlines that you see, whether it's US attacking Iran or India-Pakistan skirmish, this is what helps us. So our philosophy of managing money. Very briefly, if I were to summarize this, I would say that, and this is one of the most important slides that I have in my presentation, because while market outlook, and I know many people are looking to hear that, which will come, the most important part which remains constant through the cycle is this. So it's important for you as investors to know this. So there are four core investing principles that we follow as we put your money to work. First of all, forensics. Second is acceptable price. Third, investment style agnostic. And four is robustness. But if I were to put a simple garland through all of these principles, I would say something like this, that we at Edelweiss MF at Fundamental Equities, we are bottom-up investors. We are interested in financially clean companies. That comes out of our forensics analysis. We are interested in companies that can not only grow, but have return ratios more than cost of capital. While this is a technical term, when we say return ratios, we mean return on capital employed or return on equity. Return on capital employed or return on equity being more than cost of capital is a true measure of value, in our opinion. Third, whenever we buy a stock, we make sure that it's available at an acceptable price. What we mean by that is the upside to our estimate of intrinsic value is at least 20%. In simple terms, we are solving for at least 20% upside in every stock that we buy. We, in total, across all the funds, own about 125 to 145 stocks. All of them have gone through this sort of a rigor before buying, that at least they have an upside of 20%, if not more. And finally, we are investment style agnostic. This is an important parameter for you to understand, internalize, and think about when you think about our funds. While there are many styles that are available in market for you to invest in, we want to remain investment style agnostic, because styles, like hairstyles, changes from time to time. And in bull parts of the market, you might see growth, momentum, and various different styles do well, while when markets are bearish, it's quality, defensive, and low volatility. How do we steer clear of that is the core of our process and core of our stock picking acumen. These are the four principles that we follow in each of the stocks that we own. So in a nutshell, We are interested in financially clean companies, companies that can not only grow but have return ratios more than cost of capital. At the time of buying, we make sure that we at least have 20% upside. And finally, we are style indifferent. While portfolios may exhibit styles at different point in time, when we pick stocks, we don't have a particular style in mind. This is one slide talking about what we do. When we say what we do, we should also define what we don't do. This is another important part that you should know. And I will start with number 3, cash calls. Trust me, in my 25 years of experience where I've managed money both India and abroad, one of the most nefarious principles that a lot of AMCs that they follow is their outlook towards cash. In our opinion, cash is an asset allocation call. How much of your assets should be in equities versus that of cash is what you should think about at an asset allocation level. At the fund level, where what we are looking to do is generate the best equity-driven return for you, our intention is not to hide behind cash. Our intention is to give you the best selection of companies that there are within the regulatorily defined definition that can make the best returns for your capital. Keeping that in mind, cash in our portfolios is 5% always or lesser. We certainly don't belong to the category of AMCs who believe in keeping cash at higher levels if we feel bullish or bearish on markets or accordingly. We think at any point in time, whatever the best opportunities are available is something that we will invest in. Second, as we said, we are bottom-up investors. We don't take very strong macro views of inflation, interest rates, or one country nuking other and base our portfolio basis that. It's based on the core belief and thinking that the net alpha of macro views is 0. By the time we figure out what's going to happen, it's usually factored in the stock prices. We don't want to fall for that trap. Close to 85 to 90% of myself and my team who will speak to me, speak in front of you after this presentation, we will hear that we spend about 85 to 90% of our time in stock selection, which is what we do and which is what we thrive in, which is what we enjoy doing, and hopefully the returns are there to show. So, as I took you through the two slides, one on what we do and one what we don't do, sounds simple, isn't it? But in practice, it is not. Let me tell you, Morningstar, when they evaluated close to 44 AMCs and went through AMC by AMC with regards to the process that they follow and the returns that they generate and the risks that they take. For a couple of the funds, they voted us as the best best risk-adjusted return in that particular category. That is an example of how we follow this process over a period of time. Very simply, if I were to put the same thing in front of you, this is how it would look. That if you look at our 1-year return comparison and compare that with category average, and daily rolling is the best way to put it across. For flexi cap, multi cap, it's about 100%. And for the other two, the numbers are right in front of you. This is a bit like, when Rahul Dravid bats versus where a Sehwag bats. What we want to get to is consistency. Why is that important? The reason why it is important is for your money to be in the safe place, you don't want volatility to ruin your returns from year to year. 90% of the investors over a period of 45 years didn't make the requisite return because they didn't hold the fund for a longer period of time. Why did they lose patience? They lost patience because performance was not as consistent as it was. Keeping this in mind, we have designed our thinking, our core principles in how we go about investing, which is, broadly speaking, we want to remain consistent over trying to hit 6s and 4s, which, quite frankly, we should have done in the last test match. But having said that, this consistency, by and large, is above median performance over the business cycle. And what I am pleased to report is what the numbers show in front of you, we have been able to do so. While this is an aggregate, over the next few slides, I would take you through how the individual funds have actually stacked up versus benchmark and versus different competitors over a period of last 1 year, as almost like a review, which I am doing in front of all of you. Let's start with the flexi cap fund. This, ladies and gentlemen, is one of the most conservative funds that we run. It is targeted at the conservative investor because roughly about 70% of the fund is large cap. The rest is about mid and small cap. So as a conservative fund, if you look at how we have done over 1 year versus that of benchmark, it has a positive alpha, and also versus category average. The longer tenure that you go through, the longer becomes the alpha. And this is what I'm talking about in the name of consistency. You will see that in multiple funds, that it may not appear to you that we are shooting the lights out in 1 year. But if we keep doing it, a better than average return over a period of time, consequently, it adds up to become a 200 basis points alpha since inception. That's basically what we are solving for. And hopefully, as a bunch of investors that we want to invest in our funds, that attracts you and that helps you stay the course. Let's move on. If you look at last 1 year, the key contributors versus benchmark are in front of you. I don't want to repeat the names. These are basically sectors which we went overweight and that helped us get to the performance that you saw. On net balance, about a year or so ago, we thought financial services is one sector which had reasonable valuations and had not done well at that point in time, and the return ratios are likely to improve. That's broadly played out for us. And what you see on the right-hand side are a bunch of detractors. I would particularly mention cap goods. That is because overall there was a good bit of uncertainty with regards to decision-making at government. What I would like to highlight while you can see the numbers in front of you is that we've been able to, the contributors versus benchmark at a higher amplitude than the detractors. This is what we are aiming to solve for. If we do that successfully, fund after fund, year after year, that means superior results versus benchmark over a period of time. Let's look at some other funds. This summarizes our existing portfolios versus that of others. We will probably get a summary slide which tells you in a little better. And across market caps. This is a fund which we launched about a couple of years ago as a maiden offering. The returns, that's why you can see it's a shortened track record. But since inception, we've been able to beat the index or category average by about 400 basis points and the benchmark by about 4%. So generally, when we compare ourselves on two pedestals. One, how we fared against competition. Because when you are allocating capital to us, you are comparing us versus competition. And second, the worm of passives. So when we beat the index, then we claim that overall active management has worked. And as you can see here, the active management certainly has worked in the case of multi-cap fund. And thank you for your support all this while. Third is the mid-cap fund. This is the fund which Morningstar awarded as one of the top funds in the category. This is also one of the few funds which, if you were to do a case study for your own self, where long-term investing works in India, this is a fund you should pick. Because there are not many funds in the industry who have more than 15 years of track record. You can analyze, if you stay put for such a long period, what happens. And what happens, ladies and gentlemen, is you get close to 22% CAGR returns. I don't know of any other asset class, and anybody can raise hands and they can tell me whether there is any other asset class which, if you just stay put and do nothing, can give you close to 23% return. For the rest, we can look at the 1 year numbers, is comprehensively beaten the category average and versus that of the benchmark, not to say the Nifty 50. This has been a very good year from that perspective. I will put a disclaimer that past returns are no guarantee for future, though Radhika puts me under pressure to do this year after year, and I would make an attempt to do this, but last year has been kind to us. These are some of the contributors which are not very different from the previous fund. You can see this in terms of sectors, they have by and large remains the same. Also, if you look at the positioning, which I'll explain at a later point in time, what our market view is. We are clearly, as you can see, overweight consumption, and we are underweight, some of the commodity sectors overall. We come to the third fund, which is large and mid cap, another one of our most popular funds to talk about. I think the characteristic remains the same, that if you look at versus benchmark versus that of category, by and large, we are on the right track, which means we are in a good place to be. Similar set of sectors and similar set of top detractors and top performers. Again, I would highlight that if you look at the contributors versus benchmark and the detractors, the contributors far outweigh that of the detractors. This is the secret sauce of how we go about investing. That by and large, the calls that the fund manager has taken, this is run by, has worked better than the ones that have not worked. This is, of course, run by my colleague Sumanta Khan, who will be on the dais soon enough. This is how the positioning of the fund looks like, and we will talk about it in a bit more detail. Finally, we come to the small cap fund. This, of course, is a segment which is one of the most controversial part of the market. Some claim that the valuations are through the roof, and one should do anything in life but investing in mid and small caps. We think that this is one, along with mid caps, one part of the market which certainly is geared towards earnings growth. Certainly not suited maybe for the faint-hearted, but if you stick enough for a longer period of time, you can see since inception, which is probably somewhere around 7 years, it has given you close to 30% return. I again very humbly submit that point to me another asset class which can give you returns of that order. But the key is patience, which is why I started my presentation saying it's simple. You just have to hold on and stay put, but not easy. Can you hold your patience when US is bombing Iran? Can you hold your patience when there is a war going on between India and Pakistan? I'll leave you to think about it. In the meantime, this is how the contributors and detractors look like. Similar set of sectors, I wouldn't go into detail. Some of the names are more category specific. The current positioning continues to show our relative preference for consumption over commodity sectors. I think that's overall good to see. Finally, I would talk about basically what we think in terms of the sectors and the funds that we have overall. While some part of this will be covered in more depth, I would say that watch out for two sectors that you see in this in this pentagon. One is consumption, and second is a sector which is very much driven by the government capex, which is manufacturing. I would hold a bit of suspense for a bit longer till the time Radhika asks me this question and give you the full answer then. Hopefully you can hold your attention till then. This is a summary slide which captures the risk-return characteristics of all the funds that we run. For the people at the back, and hopefully for people online, it sometimes can act as a test of your eyesight. If you can figure out the large cap component of the flexi cap fund from here, your eyesight is certainly 20 on 20. But for now, I would tell you it's about 70%. As you can see from the left to the right, what we have done is going further down the risk spectrum, where from ELSS all the way to multi-cap fund, the risk spectrum of the funds are on the higher side. What I am glad to report is that if you look at the overweight and underweight sectors all in one roof and the market cap allocation, this is what it looks like. And in the second slide, if you look at the high risk funds, if you may call it that way, the funds where you are taking some sort of a risk. This include the mid and small cap where you are taking market cap based risks, or the focused funds where you are taking concentration risk. This is how the market cap allocation stands in front of you, where the large cap component in mid cap and small cap is less than 15%, and in the focus fund is 78%. What it shows here is that we have funds which cover the whole strata of market cap, and across the sectors, different views are being reflected by different fund managers over a period of time. So I started this presentation by saying that investing is simple, not easy. We went through a couple of core investment principles which are very core to the way we go about investing. Then we looked at whether that worked, and I'm glad to report that last year it did work if you look at what Morningstar had to say and also the numbers in terms of the way they show. Finally, we went through a bit of a review of all the funds, which hopefully presents in front of you in a nutshell how each of the more popular funds did, which are there in your portfolio. I would stop here, and over the next half an hour, as you will see the entire team, or our team, come about and answer some of the tough questions that Radhika would ask and take yours. You will get to know what our market view is and on individual funds as well. Thank you very much for your time.
Thank you very much, Pradeep, and you've covered quite a bit ground on portfolio positioning and performance. But of course, we've received a lot of questions around the markets as well, market outlook, sector-specific questions. So in fact, at the time of registrations, we've received more than 900 questions. So we're going to try to bunch them up and address as much as possible. And for that, may I request Pradeep back on stage, along with our fundamental equity team, our fund managers Ashwini Agarwal, Sumanta Khan, Dhruv Bhatia, and our head of research Anirudh Kekatpare. Along with that, may I request Radhika on stage, please, to help moderate the session.
So we've got a very large number of questions, so I'm going to try and bunch them up. But before I do, just going to spend 30 seconds introducing everybody on stage. So Dhruv manages our small cap fund. He's also the co-fund manager of our mid cap fund. He's also the fund manager of the recently launched consumption fund. If I get any of this wrong, guys, please let me know. Sumanta manages our large and mid cap fund. He's also the fund manager of our technology fund. Sumanta, have I forgot anything else? No. There you go. Pradeep, all of you have been introduced to. Anirudh joined us recently to head up the research function. Ashwini is fund manager of our ELSS fund and co-fund manager of our Flexi Cap fund. See, there, I did it really, really well. So, Pradeep, let me start with you and then I will come to everyone because we've actually got questions for everyone. The other thing I would mention is, one of the conundrums we have in this is we run a large number of funds and we are trying to give everyone updates on as many things as we can in a limited set of time. So Pradeep, of course, covered some of our larger funds. But if there are questions here on online on any other funds that the team manages, we are more than happy to cover them. We are just trying to balance that out. So Pradeep, let me just quickly ask you, everyone had questions about equity markets over the next 12 to 24 months, particularly in the backdrop of the last 6 months and also on current valuation. So maybe you can start there.
Sure. So basically we think that markets are fair value right now. But we are not negative on markets. Let me explain. So while valuations are fairly close to all-time highs, the good news is that we think earnings recovery could be right about in the corner. Our hypothesis is that earnings should come back by about second half of fiscal year 26, basically post-Diwali, maybe as a Diwali, as a gift. And that would bring to a culmination almost 1.5 years of earnings downgrade cycle which India has gone through. 1.5 years of earnings downgrade cycle that India has gone through over the last good period of time. This, in my opinion, would be driven by two major themes. One is recovery in consumption, and second is resumption of government capex. Recovery of consumption will be driven by the fact that, while we were counting the number of drones that were falling apart, 3 or 4 things happened. One is oil cracked close to about 25% over the last 3 months. Second, inflation dropped over 100 basis points, the sharpest that we have seen over more than a decade. Third, if you look at it, monsoons have arrived early. While bad news for some in terms of someone planning travel, is good for agricultural side of the economy. Finally, financial conditions have eased, and in the last budget, we saw a material boost to the disposable income in the form of a 5 to 7% salary increase that Honorable Finance Minister gave us. Net, I would say that ducks are lining up, Radhika, for consumption as a sector quite well. As you saw in the previous part, we are positive on consumption, and we think that as we get to the back half of this year, that as a sector would stand to come back. Secondly, I would also say that after almost a year and a half of policy hiatus, we are finally seeing decision-making starting to happen in North Block. We certainly saw in the first quarter meaningful contract signings and probably more to follow. Both of these will come through in the back half of this year, which is post-Diwali. The bad news is there is still a gap of 3 to 4 months for that to happen. And we have to cross the June quarter results, and assuming we make it in good stead, then we get to the good part. And in the meantime, markets are fair value. So on net value, on net balance, we are looking to invest in fair value markets with earnings in a fair bit, which means markets will not, in my opinion, crash. So the right strategy to go about investing is buy on declines in a nutshell.
Pradeep, you showed that, pentagon of 5 sectors. You also talked about consumption. And one of the things that investors have talked about last year is the very sharp rotation in terms of which sectors are leading and lagging the market. So beyond, of course, what you spoke on consumption, can you talk about some of the sectors, both from a short and medium term point of view, and also some of the potential sectors which may emerge and be of interest, because new sectors are also listing and coming to market?
I would approach this a bit of humor, if you allow, Radhika, which is, when things are going good, we go to hotels. That's one segment which is clearly kind of doing well. I would say there are some hotels where rooms are booked for the next 2 years. That goes on to show that business cycle is one part, but signs are quite robust. The other part is when things don't go that well, we land up in hospital. That's another strong growth area. With less than a lakh organized beds in the country, we think that segment is also doing phenomenally well. And what makes that happen is usually people's investing in capital markets. That's the third segment which we are all part of, and it's all growing in double digits. So invest in capital markets. If the calls have worked, we go to hotels, enjoy. Or if it hasn't worked, we'll end up in hospital. Either ways, these three companies in these 3 sectors have grown fairly well. What's important to know, Radhika, is while India's GDP growth is growing, let's say somewhere between 6 to 8%, these sectors growing at about 20% over a period of time means over time they would form important parts of the economy. And we as an economy certainly are under-indexed to these areas. What we try to do in our funds, particularly in the mid and small cap ones, is to take a higher exposure in that for investors for longer time horizon so that they can benefit from the same.
Thanks, Sudeep. Let me just move to Anirudh. And it's interesting, if you look at hospitals, hotels, and capital markets, is actually a common thread is under-penetration in all these segments. So that's interesting. Anirudh, since we've set up the research team, we are expanding research coverage. I think for the benefit of investors, if you could give us a sense on how the research team operates, how we are thinking about coverage, idea generation, increasing our sectoral coverage, that will be great.
Sure. So the broad construct of the research process operates within the FAIR framework, which Sudeep highlighted a while earlier. And one of the things which, which kind of the first steps is the forensics. That helps us filter and clean the overall companies that we will be considering for inclusion in the portfolios. And what we do in that is we check for the quality of earnings, we check for the quality of management, the governance standards of the board. And once this filtration process is done, then we start working on a financial model for these companies whereby we work out the intrinsic value basis the DCF model. Now this particular model, we do a 5-year projections explicitly, and then 5 to 10 year projections. And then towards the longer term, intrinsic value we work out. This is important because it helps us in, rather than getting fixated on the multiples, because stock prices and markets will be volatile, the intrinsic value kind of acts as an anchor in our overall thought process, and it helps us go overweight or underweight those particular companies or sectors, or even sectors for that matter. After this, we spend a lot of time in interacting with the management. Without interacting with the management, we will not be considering a particular idea. Apart from the management, we will also be doing significantly wide channel checks with the channel partners. And lastly, once all of this is done, is when we will have an internal presentation which the analysts will do to the investment team, and following which an idea is considered as within the coverage. So today we have almost about 350 companies or in our coverage, and as we expand the team, the endeavor is to kind of add more to this going forward. Apart from this, this idea generation process, there can be couple of other triggers in terms of either regulatory or policy-driven ideas which can come to the fore. But irrespective of where the idea gets generated, it has to follow this rigorous investment process and the investment framework that we have outlined. So that, in a nutshell, is how we go about it.
Yeah, this is better. Thank you. So let me come to Sumanta. Large and mid cap is, of course, one of our older and largest funds within the franchise, and it covers two distinct segments, large and mid cap. Today, two questions. How are you currently allocating across the market caps, and has the recent shift in market sentiment sort of led to any changes in weights or how you're looking at this portfolio?
Thank you, Radhika. As Tridib mentioned that we try and do a lot of bottom-up analysis to come down to which stocks to buy, which stocks to add. That means that we try and not to take any big macro calls. Now, yes, there's a fund and there's a mandate where we have to invest 35% in large and 35% in mid minimum, and the rest can be allocated across market caps. So as of today, around 49% is in large cap, around 38% is in mid cap, and the rest is in small cap. Now, if I look at the last 6 months, I would say that probably my weight in large cap has probably moved up by some 150 basis points, and a similar amount of decrease has happened in the small cap space. Not necessarily that we have decided to move in that way, but as the market evolves, the more opportunities we get, we slowly and steadily start allocating in that direction. Now the question is where we would go today. Today, if you look at mid caps are, I would say, slightly higher, but okay valuations. Large caps are slightly on the lower side. Small caps slightly higher valued. My take on this fund would be to rather focus on more churn within the segments rather than trying to shift across. This is a very good mix that the fund offers, around 49-50% large and 35 to 40% kind of mid. Try and figure it out more. This is a market where it's every day the outlook is kind of changing, right? And then allocate, right, within the fair framework, within the framework, the stock ideas that keep coming out. That's how I'm looking at it at this moment.
Radhika, as you notice, one thing I wanted to bring out in this is, which we have agreed upon, but for the investors worth knowing, that within the fund, whatever the construct of the benchmark is, we don't tend to play around the market capitalizations. We think that ultimately our expertise lies in stock picking within that category. And what the numbers, which had phenomenal numbers for larger mid cap, goes on to show is we have been able to do a good job within this, that whether it's large cap, mid cap, or small cap. And that's probably something that you will hear common from everyone. And that's what he said.
No, that makes sense. In fact, Pradeep, let me come to you on a question of mid-cap. So, of course, mid-cap is the largest fund in this franchise, the oldest one also. Now, if you could shed some light, and then I'll come to small caps after this, on how earnings growth in the mid-cap category has been. And, you know, it's a universe of 150 stocks in mid-cap, and of course, you have the small cap. But how do you think about the stock selection given current valuations? A little bit of light on earnings growth.
Sure. So, if I were to ask the audience, the three sectors that I named, one is hospitals, hotels, and third being capital markets. What is the weightage of that in a large cap index? The answer is less than 2%, basically close to minimal. So, these are the high growth sectors within the context of India as an economy. Then if someone is looking to grow their wealth, not in short term, but over a period of 5 to 10 years, then how can one ignore a mid cap as a category, or for that matter, mid and small caps as a category? I would go on to argue that if you have a view over 5 to 10 years, this is basically the sweet spot of the market, where a lot of wealth creation in the form of young budding entrepreneurs expressing their view in the form of their companies are coming to capital markets, listing themselves and presenting themselves for investments. As we make a decision on this, we find that, you know, this is the area where maximum wealth creation happens in the form of companies which have been in operations for a good while, and then overall their growth hunger is also reasonably high, but not yet mature. So we, contrary to, I know mid and small caps are the probably the most controversial part of the market, we think that this is also the sweet spot of the market if one is trying to find the growth avenues over a period of 5 to 10 years. What tends to happen is, in near term, once in a while, these go through valuation bouts, where valuations really chime up and earnings take their own sweet time to come through. What we tend to do is hold our nose in those companies where, while we are paying a valuation premium, we, through our bottom-up analysis, ensure that growth is also there at a premium to what's available. In this way, what we have found is, while markets sometimes love a sector, sometimes they hate, and you could look at defense as an example over the last 1 year. So as markets go through these gyrations of positivity and negativity, staying true to the growth potential of the sector and the company, and anchoring around the valuations which Anirudh described is the core of our stock picking, we stay true to the earnings potential of the company, being conscious of valuations, and our long-term holding time frame makes sure that we generate the returns commensurate over a period of time.
Thanks, Sudeep. So let me move to small cap. And Dhruv, I have a couple of questions because, of course, in the last 18 months, small cap as a segment has been in tremendous focus. Everyone has and gives many investors very different opinions. Some people think they're undervalued, some people think they're overvalued, some people think they're going to create wealth, some people think you should do SIPs. So I don't think there's debate about any segment as much as there is about small cap. So my first question is, objectively, how do you see valuations and earnings growth in this space?
Thank you, Radhika. So, you know, the way we think about it is, if I take a step back, is over the last year, from post-COVID 2020 to 2024, we saw very strong earnings growth for the entire space, which is the small cap category. And within that, it was driven by both the domestic markets as well as the international opportunities that these companies got. Second part was the ROE expansion that we saw in this space, right? So the strong earnings growth driven along with that, the ROE expansion, which, you know, Trideep talked about, is the core essence of wealth creation. And, you know, small caps prior to that had painful, you know, times because of the very weak balance sheets which they had. Because of the profitability that they created over the last 4 years, they had much leaner balance sheets, which drove this, you know, momentum in terms of the returns that you saw on the small cap as a category. So it had an element of earnings growth, it had an element of multiple expansion. Obviously, markets always being forward-looking went a little overboard. We saw markets being slightly more frothier in the small cap space because there was global uncertainty, geopolitical risk. Hence, we saw earnings downgrades within the small cap space, which drove certain corrections in the earnings as well as the multiples. Where we stand today, similar to what the mid cap is, that we believe that we are at a very fair valuation of where small cap is. We are hopeful that, you know, the second half onwards, we are expected to see good earnings momentum. So the downgrade cycle is behind us. Hopefully we, go towards the upgrade cycle. And as, the earnings, whatever the outcome of the earnings would be, we believe at least for the next 12 months, the returns should be commensurate to the earnings. As the momentum picks up further is where we start to see the multiple expansion again playing out. So that's the way we are thinking about from small cap as an entire category.
So the next question, I'll combine two questions because I got a couple. One is that when you pick small caps, it's a universe of 250 in the index, and of course you have micro caps and mid caps. But how are you finding the balance between safety, return, and valuation when you pick small and micro caps? Secondly, to investors here and online, what is your advice in terms of how they should allocate in their portfolio to small cap?
Sure. So from a safety and returns point, I think internally the focus actually is on safety over returns. And the reason and the essence is that in small caps, the mortality rate is very high. You'll see a lot of companies which probably were present 10, 15 years back are not even present anymore in the markets, right? And hence the importance is wealth, preservation rather than just wealth creation. Because if you're able to do the wealth preservation first, I think the outcome of the wealth creation always automatically happens. So the focus is on safety, and for the safety, the core essence, which is already spoken about, was the FAIR framework, right? And that's where the entire process and work goes. Is as long as you're able to filter, companies within the forensic, the acceptable price, the robustness of those businesses, I think then our work gets far more easier, which is what all to avoid, and then focus on what all can we look at, right? Because below 250, there are many opportunities. The second part of it is in terms of, how we're thinking about the balance. This is the, way we balance the risk and risk-adjusted returns for the market. The second part being the, how does an investor now think about investing? I think opportunities in small cap, because of where India stands today, the opportunity in terms of GDP growth going forward, the entrepreneurial spirits of the, the companies, the promoters of these small cap companies, these are at the sweet spot in terms of size of their top lines and profitability, the availability and access of capital both at the debt level from the banks as well as equity markets. I think this gives them a tremendous opportunity across multiple categories to give that next 5 to 10 years runway in terms of the growth from earnings point of view. So I think it is the right time for investors, and I think the way to think about it is don't think about very near-termish, don't think about very short-term, because if you have to play small caps, you have to have the heart to bear the pain, because the fact is that the volatility is the highest in the small caps, and hence you will see the maximum drawdowns during generally the volatile times most in small caps. But in good times, you always get, reap the rewards in terms of great returns. So I think that's the way I would balance it.
Excellent. So just to summarize, two risks, Radhika. One is the corporate governance risk, which we weed out right at the beginning. Yep. What remains is basically business risk. We trust, Anirudh to steer clear of that. And this is particularly true in the context of small caps, because if we steer clear of corporate governance risk, the rest return is kind of fairly robust over the business side.
And that's a theme across all the funds. Let me come to Ashwini, and we've talked a little bit about consumption, we talked about capital goods. I wanted to ask you a question that we got about financial services. Now, it's a very interesting sector because one, it's a large part of all our indices. Secondly, it's a sector that has gone from being just banking to banking plus capital markets, and it's evolving. And it was a little bit down in the dumps, and the opportunities sort of, positioning has changed. So what is your view on the opportunity and positioning within financials as a space?
Thanks for the question, Radhika. Clearly, we have bottomed out in terms of industry perspective from the BFSI category. Money is the raw material for the BFSI category. And if you see, RBI started tightening liquidity from December 2023, and the deficit was to the tune of roughly 2 lakh crores. And from March 2025, the deficit turned positive, and now we are roughly a positive roughly 2 lakh crores. So there has been quite a big swing in terms of liquidity. Government spending was not there for the initial 6 months, then it picked up, and all these factors caused a problem in the deposit creation. Further all, RBI also nudged banks and NBFCs to reduce lending to the retail category, to the MFI category, because there was some overheating happening there. So all these things have been taken care of. Has the government spending started? Yes, government spending has started, and they are trying to front load it. Has liquidity become positive? Yes, it has become positive by roughly 2 lakh crores. RBI has also cut 100 basis points as repo rate in last 6 months, one of the fastest. And in the last policy itself, there was a CRR cut of 100 basis points. That was clearly a bazooka, which will give you roughly 2.25 lakh crores in the system by December. So this 3% CRR is the lowest ever seen apart from COVID. So that is the kind of a growth impetus RBI wants to put in. And let me raise another important point. If you look at last 15 years balance sheet of all the banks put in, it is the cleanest at this point of time. This year itself, in FY25, the entire banking system did a PAT of roughly 3 lakh crores. And in the entire last 12 years, if you see, the PAT of the entire banking system was roughly 11 lakh crores. So roughly 30% of the PAT of the banking system has come in this year itself. With liquidity increasing and the corporate health in the best of the shape, because courtesy the buoyant market or the buoyant economy in the last 4 years, I think both the lenders and the borrowers are in best of the shape. So it is the lending which will benefit the most, because the cost of the raw material money has gone down clearly. So we would prefer NBFCs at this point of time, because their cost of borrowing will come down over banks. And capital market, because of lower penetration, will continue to stay. But just for the event in the last 6 months, I think NBFCs will be the bet. And if you look at the valuations, if you see the valuations as compared to other sectors, PSU banks are available at a PE of 6 to 7. Most of the PSU banks are available below 10, and private sector hardly would touch any 15. The best of the NBFCs would be touching 18 to 20 PE 2 years forward. So compared to other sectors, they are in the best of the shape. So we are positive on BFSI sector.
Thanks, Ashwini. I can now request, we can take some questions, because we've taken quite a few from the online audience. If we can take some questions from the audience here. Do we have mics that can go around? My only request is that you restrict the questions to anything equity related and funds managed in this section. Any funds that are not covered in this section, we have a second session of Q&A. So happy to take questions on hybrid funds, fixed income, business cycles, recently listed IPO after that. So if we can restrict that. Do we have questions? You can raise your hand and we can pass a mic. Yes, there's one at the back. Right at the back. I saw a question at the back.
Around 4-5. First of all, good evening to all of you. Wonderful session organized. 4-5 months I had invested in US technology fund, thinking that possibly something good will turn out from Mr. Trump's coming to the power, but probably I might be proved totally wrong. Also, another reason was to make my portfolio diversified. What is your call? I mean, I don't know whom to exactly address the question, but submission to all. What is your take on, should I continue to hold on US technology fund, or should I think of switching on? I know it's a little personalized question, but since nothing much has been talked about fund of funds, international fund, probably you may like to answer. Should I continue holding, or will it be better to switch on to new launches like SIF or something which will be coming up?
So I'll do this. We were going to cover fund of funds, including US tech, in the next section. But we can do two things. One, since Sumanta manages tech as a sector and manages our tech fund, if you have comments on technology and you want to help the gentleman, and if I can ask Niranjan to then just come up and quickly help you answer your question on US tech. Niranjan, you can also come up while Sumanta starts.
Hello. Just on the outlook part, see, what has happened is that over last 1 year, there has been quite of uncertainty on the macro. So if you see US 10-year yields, they went up, and that, there were fears that the US economy can get into a recession, right? So what happens in such a scenario is that corporates start postponing their decisions, right? And because of it, there are fears that, the tech spends might come down. Now, while there is some truth behind this fear, Overall, the global macro, if you look at the tech outlook, people are going through a very, very big change. AI-related transformation deals are the need of the hour. There are serious cost advantages that organizations can benefit. Then AI has many opportunities, right? If you look at the banking software system written in COBOL, AI can help you, upgrade the entire banking system. So these opportunities are huge, but it will take some bit of a macro benefit before the corporates start, start spending on technology. Discretionary spend has been held on for a very long time. I've been told that you cannot withhold discretionary spends for a very long period of time. So my outlook on tech is in general very positive. A lot of positive things are happening on AI spend, on the hardware part, on the software part. So overall, my outlook is positive, but yes, we would need a bit of a sanctity in the US economy, right? Especially if the 10-year yield starts coming down, I think that would be a good point from where you will start seeing returns in the tech part.
Niranjan, do you want to add anything? I just thought we'll wrap up the question because we shouldn't break it.
Thanks. So we're going to cover it in more detail, but definitely US tech as a theme has been performing really well over the last 3 to 5 years. As he mentioned, a couple of triggers, specifically in US, has triggered some earning downgrades in the sector. In last 6 months, we have seen the market, especially the tech stocks, moving sideways. But as far as medium term and long term is concerned, and specifically your question to US tech fund, which is a FOF, and we invest into a JP Morgan tech fund, US tech fund, I think so it is better you continue to hold for long term. Of course, you would have done that investment keeping in mind at least 3 to 5 years. From 3 to 5 years, the outlook definitely is positive. But be cautious in the near term because there could be some volatility over the next 6 to 12 months. Thank you.
Thank you. There's a question there. If you have a mic or we can pass a mic. Yes.
Yeah, ma'am. In your portfolio, I am seeing a lot of international funds. And I think we have talked more about, what is happening in India. Yeah. So if you are covering otherwise, then, we can do it. But otherwise, I want to know because you have a lot of schemes which are specifically for international fund. And also, now taxation for international funds is quite, it is similar to what is in India.
Yes, yes.
Unlike, earlier, which was, not that conducive. So, comment on that.
So, look, we manage international mandates in multiple different ways. We, of course, have the 6 funds that JP Morgan manages, which our schemes feed into. And select funds like Technology Fund also have global components. Some of the passive funds have global components. We will be covering international funds in the next section. So then I'll answer your specific questions there. If there's a particular market or a particular question that you have, you can place that with me and we'll make sure the guys cover it in the next section. Is there any market you had a question on, specifically on international funds?
Basically
China. Okay, we'll cover that in the next section for sure because we know we have questions on China on the list. We'll make sure we cover that. Yes.
My name is Sandesh. What is AI industry helpful for this mutual fund industry? And US opportunity fund, what is use?
Okay, so US will cover in the next section. Trideep, you want to take the AI question?
Yeah, I have a question.
Yes.
I think in a nutshell, AI is
You take the AI question and then I'll come back
AI
to you.
is a productivity tool. Certainly we are using in our research process. The information that we could take about close to 10 days to assimilate, read and make sense of, we are now able to do in a matter of hours rather than days. So it has increased the efficiency in the way we go about doing that. I don't think we are there yet though. I think we can do even better than that. At the moment we are experimenting with few options, but if you ask me this question over a period of, let's say, next year, I think by next time we would have figured out exactly how much investments that we need to do. It's one of the areas that we are looking to invest. Hopefully that will aid decision making more than anything else.
I have 4 projects going on, including investing in the AMC on AI. But I think in next year's annual update, we'll actually be able to say what the projects have delivered. Let me take a question from the gentleman in front, and then we'll end this session. Yes, sir. Yes.
See, my question is, in the near future, I understand there's going to be an IPO of NSE. Now, what is the size of the IPO? Because my experience says, whenever a big size IPO comes, the market rattles. And I saw it 3 months back when there was a combination of Hyundai IPO, NTPC, energy, etc. Markets were coming down 10% or so. So if that is happening in the next 3-4 months, what do you think the market, how will it react? Now today there's a IPO open. That also is a 12,500 crore IPO. But I don't, I'm a little worried about this NSE IPO. Will it be 25,000 crores or 50,000 crores? Is it going to happen in the next 1 month, 3 months? And what do you feel will be the impact on the stock market? Will the market rattle as it has rattled in the past? Even 5 years, 10 years back, I've seen, 15 years back, a big IPO coming, when there's an easy allotment, whole market shakes actually.
I think 2 or 3 strands to answer. Though I won't be able to give you an answer. I won't be able to give an answer specific to NSE because that will be very stock specific, which we will stay away from. But I would say Indian market has evolved in such a way that single IPO will probably not kind of cause so much volatility that you are thinking about. I'll take a different example. Like for example, FIIs. FIIs control about 16% of the market. They have been selling left, right and center over the last 1 year. Despite that, if you look at how the market has moved, it's been able to absorb that sort of a flow. Now that number is a far bigger number than an NSE IPO. Whenever that shape and form, not only NSE IPO, but all the 3 IPOs that you said put together will not tantamount to their amount of selling that they have gone about doing so. So I think be rest assured that one IPO or a few IPOs will rattle the markets. I hope you are not confusing coincidence with correlation. When markets have corrected and the IPOs might have happened simultaneously, though not one as a result of other. Generally, there could be other events which might have actually caused the markets to correct, which generally is the case. We attribute different reasons to it. The final answer that I would give to this is, this you should expect in India. As more and more business models come to the forefront, it is only a shame that the largest stock exchange, which has a dominant market share in the country, is still not listed. You should ask you, why is it coming to listing so late? It should have happened, maybe we know the reasons, but it should have happened a long time ago. Likewise, still there are quite a few companies which are kind of, like the other one, which, as you were mentioning, which is open today. These are some of the, good businesses with strong industry positioning. They should be listed. Investors get a bigger choice to invest. We get a better choice to kind of, put money our work, including Hyundai Motors that you talked about. So I see only good in it. I think net market will very quickly adjust before you think about it and move on. I wouldn't think that the markets will face jitters because of that. If Trump changes his view in the first week of July by increasing the, the tariffs, that might have a big more impact than this one. Though don't confuse this with that is the question.
Okay. On that note, I'm going to, because Trump can be a long conversation. So I'm going to just pause here. We can take future questions in the next session and hand it over to Shikha for the next set of panels and presentations. Thank you.
Thank you, Radhika, and thank you to the Fundamental Equity team for your candid and thoughtful responses. But also, I really appreciate all the investors for their sharp and focused questions. These questions really help us gain insights into what's on your mind. So now that we've heard the Fundamental Equity team, now it's your turn. Let's take your view on what's your preferred investment strategy at this point in time. So can I request you to again look at your phones, please, for the next poll. So you would see certain options. Please select one of them. You can switch on your camera and scan or go to menti.com. Shall we see the results? So interesting. Well, a lot of people would actually wonder that maybe go with the trend would be the response. At this point of time, most people want to stick to quality companies only. That's an interesting perspective and insight for all of us. So I guess most of us would understand that each of these investment strategies, while it will have its own pro, there are certain cautions also that we must apply. And that leads me to my next session. Now, earlier during the session, Radhika did mention that we have an independent team which leverages factors in their investment approach. So, to learn more about that, may I invite our heads of factor investing team, Bharat, Lahoti, and then followed by Bhavesh Jain, please.
Thank you. Good evening, everyone. Just to understand what is factor investing all about, we have seen a great poll and many people are looking different styles of investing. Somebody is looking for quality companies, somebody is looking for growth companies. And what are all these things? Why does it make sense? And why do people think about it? Can this investment style can make money? Just to get a sense, if you look at it, in 1996, actually, the NSE launched the India's benchmark index Nifty. And if you look at it, what is this benchmark all about? This benchmark is India's top 50 companies by market capitalization. What does it represent? India's top companies. So if India has to grow and if you want to participate in India's growth story, how do I participate? You can participate through Nifty. Now, what is factor investing all about? You identify a group of stocks which has certain characteristics which can deliver performance. Nifty is one such index or one such group of company which helps you to participate in India's growth story through that index. This is a factor which is what you call the large company portfolio. This is a company where you have created a portfolio of large companies which includes the likes of the big moths of Reliance, Infosys, TCS, HDFC Bank. This is the portfolio which is created. Now, what is factor investing? It's a science of creating group of companies which displays a particular characteristics which can deliver returns. This is a portfolio which can deliver returns in line or better than India's growth trajectory. What we talk in general about is that Nifty can grow 12-13%, which is a combination of India's GDP growth rate plus inflation and some productivity gains. This is the 12% growth portfolio, 13% growth portfolio, which you can think about it, which can be delivered by using one single science-based approach of picking up stock based on market capitalization based. Now you can extend this idea more beyond it. Can I identify growth companies? Can growth companies deliver better returns? So can I build a portfolio using growth companies? And many people in the poll had actually preferred growth companies. So can I build that companies because growth can deliver a great set of returns, and growth is one of the factors which you can talk about it. How do you identify growth companies? If you look at top 100, 200 companies by universe and you sort out companies based on growth metrics and you pick up the best 30, 50 companies and that becomes your growth portfolio. So that is what you call factor investing. Similar you can do with quality, similar you can do with value, where you pick up stock based on low valuation because that is also a factor which we look at. Another thing which you can look at it, why this approach is very interesting, because it is a science, it creates a discipline. And when you look at it in investing, one of the important aspects about investing is about discipline. if you create discipline, and you would have seen people who have done SIP, the discipline approach has delivered a lot of set of returns, and that has created actually good set of returns which results because of the discipline process. Thirdly, you can reduce risk. Given that how you build portfolios with this kind of methodology, you can actually reduce risk. For example, if you add a factor which is low vol, which is buying companies which has low volatility in the bad markets, actually you can reduce risk. So you can create portfolios and reduce risk of the portfolio depending upon how you want to create. This brings to how we can bring a tailor-made solutions. So depending upon our requirements, how do you want to create portfolios, we can actually tailor-made solution using this approach where you actually break down portfolio companies into different characteristics and build out portfolio to that extent. Now what has happened in factor investing, if you look at it, and you look at long-term track records of factors, how factors have behaved, you have few standardized factors like growth, quality, value, momentum. You would see actually momentum is one of the factor which is actually done fairly well in last 6-7 years. It has been number 1 or number 2 in last 6-7 years. It's one of the important factor, though the general narrative would be in India that either growth will do very well or quality will do very well or value would do well. But in contrast, actually what has done very well in long term actually is the momentum which has delivered last great set of returns over last 6-7 years. Better returns, number 2, number 1 or number 2 in last 6-7 years. But what has happened in last 1 year, if you look at it, momentum as a factor, when you look at CYTD returns, the CYTD returns has been bit patchy. Primarily, if you look at it, last 1 year, there has been a lot of events which has happened in the markets, starting from the general elections, where the elections outcome was very different from the general poll, the expectation in terms of exit poll, which is followed by the budget, where the budget had increased the taxation, followed by a lot of events globally with respect to Iran, Israel, Ukraine, Russia, the Trump elections, the tariff war, the India-US, India-Pakistan war, and the recent conflict between Iran and Israel. So you would see actually there has been a lot of events which has happened, and in the market itself there has been a lot of volatility in the market. In such kind of environment, generally momentum doesn't do well. And what is reflective of the fact is last 6 months has been a bit poorer for momentum. But having said so, what we see from a long-term track record perspective, when you look at 3-year, 5-year, 10-year record, actually momentum has been a great set of factor compared to other set of factor which you would see in a long run to that extent. Now, how do we build portfolios is we mix all these factors to create different set of portfolio, what we call multi-factor portfolios. So that is how we build out portfolios. If you look at it, what has worked well in last 1 year. So last 1 year, market was actually looking for growth stories. Given that global growth slowdown has happened, and Trideep has alluded about the US market being slow, the recession fears are very high. India market, if you look at it, last 3 quarters, the result seasons were pretty poor. So market was actually looking for companies where growth is actually more visible. So market rewarded some of these growth companies. So growth factor did very well in last 1 year. What also has done well in last 1 year is value as a factor. If you look at it, 2024, we can look at it, 2024, value also has done very well, and value also had a great set of rally in last 3 years actually, right from the COVID lows. If you look at it, value has done very well in last 3 years. The value has also done very good in last 1 year. Primarily, if you look at value was tilted towards more of PSUs earlier in the year. Now the value is tilting towards more of financials, which is coming out in this current year. So that is another factor which has done very well. One factor which has not done well, we spoke about it, momentum. Given the volatility was very high, momentum has not done well. Another factor which has not done well in last one is quality. Many people were looking at quality as a matrix to identify companies, build portfolios. Actually, that is the factor which has not delivered well in last 1 year. Primarily, if you look at quality companies, many of these quality companies fall in the consumer FMCG basket. Many of these companies are in the IT space. These companies have not delivered well because of valuation concern. The valuation of many of these companies are very high, and hence they have not delivered well. If you look at it in terms of sectors which have done very well for our portfolios, some of the high quality NBFCs, the capital market plays, insurance, the financial basket has done exceedingly well for us. What has not worked for us is we have been underweight in private banks and IT. IT, as Sumanta has alluded, has been a bit patchy in terms of macro data. We were underweight in it. That has detracted our performance. And if you look at it, healthcare has been one of the star performers for us. Primarily these companies, especially the Indian pharma companies and the healthcare space, where we see a lot of growth opportunity. That is the space where we are seeing visible growth. Trideep alluded about hospitals. So that has contributed well for our set of portfolios in the our portfolios. And finally, some of the overweight position in capital good companies, given that market actually saw a lot of volatility, resulted in some trade act. So that's where we have. And if you look at long-term performance of portfolios, some of the funds which we manage have seen great set of returns on a rolling 1 year, 3 year basis when you look at how much time we have spent above median in terms of performance. So that's where I will stop and I hand over to Bhavesh who will cover up the fund structure.
So good evening everyone. So first of all, let me thanks all the partners and all the investors for your support. Last 1 year has been a great year overall for the AMC and particularly for our team. Our arbitrage fund crossed 15,000 crore of AUM. Our balance advantage fund crossed 12,000 crore of AUM. A couple of other funds like aggressive hybrid fund crossed 2,500 crore. And we launched the most successful or the biggest NFO in our AMC history, which was business cycle fund. I'm sure a lot of questions will be there on this fund, which we will try to answer. But that was the biggest NFO we completed with the AUM collection of close to 1,800 crore. Now I will start talking about some of the, you can say, big funds which we are managing. But I will start from where Trideep left. Investing is simple but not easy. And this is a product where we try to make your life simple. Right now, there is a lot of questions in your mind regarding valuation, regarding earnings, whether US, China, Iran, Israel, India, Pakistan, so many things. Then what RBI will do, what Fed will do. This is a product where we try to solve most of your problem in a product where you don't have to worry about a lot of things, because a model-driven strategy which try to navigate your equity allocation on the day-to-day basis with a systematic approach where overall the intention is to deliver equity-like return but with much lower volatility. So a product where equity is in the range of 30 to 80% and managed dynamically, and over last, you can say 5 years, 7 years, 10 years, we have been able to achieve a lot of what we were supposed to do. Now you will see last 1 year has been extremely challenging. You can break this year into two half. First couple of months were very good. Then we had 5 consecutive months. First time in history of Indian market where we saw Nifty giving you negative return for 5 consecutive months, and then an unexpected bounce back with so much of geopolitical tension, where earlier we were correcting almost 15% because there was a war between Ukraine and Russia. And this time when the war is at home, India and Pakistan, Nifty actually in last 3 months is up almost 20%. So that is where our asset allocation model helps you. You will see in all the positive month, our equity exposure is more than 60 to almost 70-75%. And in all those 5 months where markets were negative, our actual equity exposure was less than 50%. So we try to manage this volatility dynamically, and that is something we have been able to achieve when you look at numbers. Look at our returns over last 1 year, 3 years, 5 years. In most of the period, we are able to deliver almost 80 to 90% of what Nifty has delivered, but with 2/3 or less than that of volatility. If you look at drawdown over last 5 to 6 years, Nifty has seen a drawdown of almost 38% during COVID. Our worst drawdown is close to 15%. So almost 60% lower drawdown, almost 40% lower volatility, and almost 80 to 90% return. This is something we were able to achieve, and that's why I said that this single fund will solve a lot of your queries and a lot of your questions regarding market timing. Again, if you look at long-term performance, almost every year, every period, you will see other than last 1 year, which I'm sure you know the model which we follow, which may be discussed in later part, a trend-based asset allocation model, and as Bharat rightly mentioned, momentum had a patchy last 1 year. That's why our balance advantage fund over last 1 year is underperforming the category. But look at 3 year, 5 year, 7 year, all other time period, it is outperforming the category average. So that is something where as an AMC, we try to always deliver consistency of performance, and that is quite visible when you look at the long-term performance. Second important fund which you wanted to discuss is our aggressive hybrid fund. During COVID period, this was a fund with less than 10 crore AUM, and thanks to support from all the customers and investors like you, today the fund is almost touching 3,000 crore of AUM. Great run over last 5 years. It is again combination of a factor-based approach where momentum as a factor, which is slightly overweight in this portfolio while selecting stock, has helped us over last 5 years to generate great return. But in years where momentum was not working, like last 1 year, value and growth again has helped us. So a combination of multi-factor portfolio like growth, quality, value and momentum in aggressive hybrid fund has helped us to deliver very good performance. Same metrics if you will see, we have delivered almost 120 to 130% of what Nifty has delivered with 3/4 of the volatility. So it is as simple as that you are taking 75% of the risk in what a Nifty is taking 75% of that, and delivering returns which are almost 120 to 130%. So on a risk adjusted basis, you are actually improving your returns in a significant manner. Again, as we are into the period we are right now, I'm sure volatility is here to stay because on 9th July, again, you have another event where what Trump will do on tariff, we don't know. Later, we will have Fed meeting, and after that, we will start our own. So we are already starting our own election quarterly results. So a lot of volatility will definitely be there. And I think in that process where people are not able to decide whether they want to take a cash call right now, whether they want to invest, whether they want to wait, I think this is a better product where if upside continues, you capture almost 120, 125% of that. But if at all the volatility comes back and market takes a U-turn, your downside is protected in a significantly better way. So I'm sure those who are confused at this point of time, Balanced Advantage Fund and Aggressive Hybrid Fund are the two products which will help you to navigate this volatile period. Again, long term, you will see most of the time period, the alpha we have generated is anywhere between 3 to 4% over and above the category average. That again itself is a, you can say, differentiator between why a factor-based aggressive hybrid fund is doing better. And as I said, the momentum as a factor and a combination of other factors have helped us significantly to beat most of the funds in the category as well as our benchmark consistently. One more important product, again we are talking this, you can say, set of products, particularly keeping in mind the markets are extremely volatile. So large cap is a category which people in a way has, you can say, not talking or not interested much in today's environment, because either people are looking at passives like Nifty index fund or others, or people are looking at hybrid funds like Balanced Advantage Fund and Aggressive Hybrid Fund. But again, we are following a systematic, you can say, systematic approach in managing our large cap fund also, where our approach or weightage to growth as a factor, quality as a factor has helped us to generate alpha in a category where 70% of the funds are not able to beat the benchmark. Again, over here, you will look at our long-term track record. Consistently, we've been able to beat the benchmark. Though the alpha is less, but you will see this is the category where 70% of the funds are not even touching the benchmark. We are able to beat them consistently. Here also, we maintain the same stance. Right now, though mid-cap and small-cap have bounced back very sharply, valuation concern over mid-cap and small-cap is still there. In that context, large-cap can be a better hiding space where, though the amount of growth we expect in mid-cap and small-cap will be significantly higher, but right now it is a dilemma where people are thinking whether safety should be given more importance over returns. And in that context, I think large-cap can also become a better alternative. So these are some of the product where we have been, you can say, delivered much better return over last 3 years, 5 years, 7 years. Our portfolio positioning always has been large cap biased, whether it is Balanced Advantage Fund, whether it is Aggressive Hybrid Fund. You will see almost 70% of our portfolio is in large cap, and we have a very small allocation to mid cap and small cap. When we talk about most of our factor-based funds, our universe is normally top 300 or top 500 stocks, and most of the strategies are large cap biased because as you know, we are running a rule-based strategy, a factor-based strategy. A portfolio has a lot of portfolio turnovers because we churn our portfolio quite frequently to avoid some of the you can say, volatility of the market, and that is the result that most of our strategies will be large cap biased. Finally, sector positioning. Right now, if you'll see some of the factors which we follow, whether it is growth, whether it is value, whether it is momentum, are heavily tilted towards healthcare. That's why you will see most of our portfolios are overweight on healthcare and capital goods. And similarly, some of the sector where momentum is missing or earnings is under question mark, normally you will see we are underweight on those sectors. So oil and gas and IT particularly are the sectors where we are underweight in most of our funds. So that is the brief which I wanted to give from my end on the funds which we manage. I'm sure that will be a lot of questions on other funds also, where we have seen a lot of IPO, question on IPO fund, question on business cycle fund, question on arbitrage and other funds. Maybe we can take that on a later part. So that is the update from our end on the funds which we manage. So over to you, Shika. Thank you.
Thank you very much, Bharat and Bhavesh. And yes, of course, we received multiple questions for our hybrid and factor-based strategies. But before that, so up until now, we've spoken a lot about relatively medium to long-term investing strategies. Now, but how about our shorter-term allocations? What are we doing for that? So now let's just take a little sense around it. Sorry. Yeah, let's just take some sense around it. Can I request you to please, again, go to your phones, open the camera and scan and pick the allocations. So you can pick multiple options and they would have to add up to 100. Shall we see the results? Oh, they are moving around, so we can probably wait for another 10 seconds to see. Fixed deposit was just leading a couple of seconds ago. Very interesting to see debt mutual fund is also an option. So this really brings me now to our next session. What if there are some more efficient strategies that we can consider for our shorter term allocations? So for that, may I invite Niranjan Avasthi, Head Products, Marketing and Digital on stage, please.
Thanks, Shika, and hi everyone. Thank you for joining us today. It's really heartening to see that people still believe in debt mutual funds and fixed income oriented solutions, because the way mutual fund flows are, we believe everyone is just running behind equity. But as far as asset allocation is concerned, it is very important and imperative to have allocation to fixed income as well. And today I'll just take 5-10 minutes to introduce some of the very interesting income solutions for your portfolios. 2023, something happened and people were furious. The debt mutual fund taxation changed, right? It became completely taxable as per your slabs rate. And since then, we have seen a lot of people are finding it difficult to find better alternatives which are much more tax efficient but are similar in terms of tax, in terms of risk return metrics. Here are some interesting solutions that we want to bring to the table, and I'm sure a lot of you would know about them. One is arbitrage fund. One is Edelweiss arbitrage fund, or rather arbitrage fund as a category. It is a very simple category. It what it does is, in equity market, as you would know, there are futures and cash market. It actually tries to identify spreads or identify opportunities where you can buy in cash market, which is buy a stock, and sell it in future at a higher price. and the difference is nothing but a risk adjusted return, or rather risk-free return to the investor. Arbitrage fund usually perform in line with the interest rates in the economy. So if interest rates in the economy are say around 6%, 7%, the expected return in arbitrage fund could be closer to that. What is important is, because arbitrage funds invest almost more than 65% into equities, the taxation is as per the equity mutual funds, which is 12.5% after 1 year, which makes it much more tax efficient for your fixed income oriented solution. So if you're looking to invest for maybe 1 month, 2 months, 3 months, or any time horizon beyond that, arbitrage funds are a great solution for you. Second is our multi-asset allocation fund. Now, you would have seen a lot of multi-asset allocation funds where you would want to take exposure to maybe gold, equity, fixed income. What we have done is, in our multi-asset allocation, we have taken all these 3 asset classes, but tried to generate income out of it, which is, when I say income, which means low risk returns, which are closer to fixed income. What we do in this fund is, in equity, as I explained, there is arbitrage, which is generating risk-free returns. Almost 25 to 45% of this portfolio, we generate equity arbitrage return. 45 to 65% is fixed income, which is bonds, government securities, and remaining 10 to 15% we invest in gold and silver. But here again we try to do arbitrage. So we buy gold and silver, but we hedge it, taking a short exposure in future. Like equity arbitrage, gold and particularly silver also generates a very good risk, tax-free, risk-free return in the long run, roughly around 9 to 10% on an average. When you combine all this together, what you get is a very, very low risk, income oriented product. If you look at the performance in last, say, 2 years, and happy to announce that we launched this category when the taxation changed 2 years back, and this week it has completed 2 years. It has generated a post-tax return, and this is post-tax 7.3% return for our investors, versus a CRISIL short-term bond index, which could be a benchmark for all the debt funds that you may have invested, has generated a 5.7% post-tax returns. So on a post-tax basis, this becomes a very important solution which you can have in your portfolio for short-term allocation or even long-term allocation for risk-free returns or or basically fixed income oriented returns. The second, arbitrage funds also, as we spoke, they provide better risk-adjusted return, better post-tax returns. In last 3 years, 5 years, and even 1 year, it has generated a better return than most debt funds on a post-tax basis. So these are some solutions that you can add. There's another category which is brewing up, which is income plus arbitrage. It is a fund of fund structure. It simply, what it does is invest 35 to 40% in arbitrage funds and remaining in debt mutual funds. Because of this structure, again, the return that are generated by this fund attracts a taxation which is much better than a debt mutual fund. It attracts a tax of 12.5% after 24 months. And again, it works like any other debt mutual fund because it has arbitrage, which is risk-free, and fixed income products or debt mutual fund, which gives you returns in line with the interest rates in the economy. So these are the 3 categories which you can, have it in your portfolio to complete your asset allocation, specifically if you're looking for any short-term solutions in your basket. So thank you so much. Over to you, Shikha.
Thank you very much, Niranjan, for a comprehensive walkthrough on alternative options that are available to investors for investing over a 1 year and 2 year period. So now this brings me to our final session, our final Q&A with Bharat, Bhavesh, Radhika and Niranjan. May I request you to please come back on stage. The session would be moderated by Varun Sanan, who heads sales for our West region.
Good evening, everyone, and a very, very warm welcome to the final panel. This panel is away from the one that we did before. The one that we did before was our fundamental equities panel. This is focused more around our factor-based funds, which are gaining a lot of popularity. If you remember, Bhavesh mentioned that we did our largest NFO, which was our business cycle fund, which is a factor-based fund. Plus a lot of these passive offerings that we launched over the last 2-3 years, which were based on factors. Plus, we will be covering our hybrid funds, questions around those. I will go to Radhika for a lot of these asset allocation questions and Niranjan for the international funds that a lot of you wanted to hear about. So it's going to be very interesting, and we're going to take questions after that from all of you as well. So let me start with you, Bharat, first. We've spoken about some of the factors that we run. We've spoken about some of the products that we have around that. Can you just run us through the core processes around some of these factor-based funds?
Okay, great. So the way we run factor models is that the basic process starts in identifying what drives returns. So when we look at markets and we talk to investors or the matured investors in terms of what made money for them, and we discuss all these questions, how people make money in market and stock market, people give you questions, answers like the growth of the company has been great, the company was delivering great set of return ratios, and we try to model all these data points in terms of whether there is actually data points reflect in the stock market price behavior or not. So what we call is this process as a factor identification process. We test these factors across cycles, whether it works within specific period market conditions or it works across cycles. So we test these factors through a 10-15 year of back testing where we look at these factors, and then we collate all these factors to create a portfolio from that perspective. So that is how the process building happens for a factor investing. It's not an ideation which happens from a fundamental point of view, how we look at things, how a fundamental investor will actually think about a stock and then do the rigorous analysis well in advance in terms of how work has to be done. So that is how factor investing works around it. In terms of selection of factors, how do you select factors? We look at a longevity of factor. How does the longevity of factor works around it? Whether the factor works only in certain set of regimes or it works across cycles. So that is one important aspect. The second important aspect is about how do we think about factor? Because when you look at factors history, there are periods when certain set of factors work very well. Like for example, in a volatile period, momentum will not do well, while a low wall will do very well. But in periods of very high market risk-taking capabilities, actually momentum will do very well, while low wall will not do well. So when we build portfolios, we try to mix and match different set of factors. We try to create a multi-factor portfolio rather than relying on one single factor to build a more durable, more consistent set of portfolio.
Great. When I was growing up, I used to hear my dad talk about investments, and he used to talk about blue chip stocks. And then when I started working, I heard blue chips plus emerging equities. So those were the two categories. Radhika, let me ask you this question. Now the mutual fund portfolios have developed quite a bit. The asset categorizations happened very, very crisply. Now we have products across large cap, mid cap, small caps. We've also got international funds, debt mutual funds, and now we've got a lot of these factor-based funds or funds like our business cycle fund. So if you have to draw out a portfolio, how do you think these fit into a client's portfolio?
So look, I think as the market expands, whether it's mutual funds or restaurants, the range of options you have will increase. But of course you can't, and nobody would recommend that you invest in every fund or eat at every restaurant because you'll have indigestion in both cases. So what is important is to have a core set of categories that you invest in, and that really forms your thali, your portfolio or asset allocation. So for instance, I'll just give you my own example. When I build a portfolio that's 100 rupees, I broadly know that I want to park 60, 70 rupees in Indian equities. And I park that in 2, 3 categories of funds. Now, in my case, it could be mid cap, it could be small cap, it could be large and mid cap. Then I know I want to have a certain amount of money that goes into international funds, and maybe I want US and China there. And then I know I need some money in short-term solutions. So for most people, life finally comes down to 2, 3 major asset class buckets: equity, and then it has large and mid cap; fixed income if you want gold, and then international. And within those 2 to 3 categories of funds. So most consumers, I think, need 5, 6 categories. Within each category, you can have 1 to 2 AMCs. That's all the diversification. If you put all this math together, actually most consumers don't need more than 8 to 12 funds in their core portfolio. And I think that's a bulk of what you do. Now, a little bit of experimentation when something comes in, that you can always do. And within each category, you can make a choice. Do you want to do an active large and mid cap or a large and mid cap index fund? That's a choice, and there's actually no either or, Varun. You can choose both.
Pavish, let me ask you the next question. Now, this one is a question that's quite popular, and we've got this question multiple times. Now, balanced advantage fund as a category has become very, very popular recently. And there are multiple funds in the category. There is us and our competitors who have their own products in the category. Now, how is it that our fund is different from the peers? And given the last 6 to 8 months of volatile times, how is the fund done, and what is the way forward for it?
Yeah, I think the category is becoming quite popular, and we are almost touching 3 lakh crores over there. The most important difference between Edelweiss Balanced Advantage Fund and most of the other funds in the category is our asset allocation model. Normally, anyone comes into a Balanced Advantage Fund to get proper asset allocation, and that's why model becomes the deciding factor whether a particular style is better or not. Actual answer is there is no style which is perfect. Neither there is any model which will be correct 100% of the time. So each and every model, each and every strategy will have their own, you can say, advantages and disadvantages. Now broadly, you can divide Balanced Advantage Fund as a category into 2. One, a valuation-based Balanced Advantage Fund, which is quite popular. I'm sure most of us try to do that thing day in and day out, wherein we try to say whether markets are expensive or cheap. You would have seen the first half of the discussion, we talked a lot about valuations. So that is where a particular style of Balanced Advantage Fund manages their asset allocation in a simple way. If valuations are expensive, cut down your equity exposure. If valuations are cheap, increase your equity allocations. So like for almost last 3 to 4 years now, valuations are expensive, and that's why a valuation-based Balanced Advantage Fund over last 3 to 4 years would have kept an equity exposure of less than 50% in their portfolio. Against that, the model which Edelweiss follows is a trend-based asset allocation model, Edelweiss Equity Health Index. As the name itself suggests, we work on the basis of trend. So if trend of market is positive, we will increase our equity allocation, and if trend of markets is negative, we will reduce our equity exposure. Again, you will see last 1 year has been extremely challenging, particularly last 6 to 8 months, where there is no clear-cut trend. We touched almost 25,000 when our budget was announced in July 2024. If we look at last couple of days, we are back to 25,000. That means last 11 months, if someone is out of market, he will think market has not done anything. But last 11 months has been the most, you can say, volatile period. Though returns have been almost flat, but the amount of volatility we have seen, particularly event-led, starting from budget, after that yen carry trade reversal, then Trump, and then geopolitical issues, India, Pakistan, US, Iran, so many other issues, almost 100 basis point rate cut in between. So because of so much of event, there is actually no trend, and that is the reason where we are underperforming over last 6 to 8 months. But as I said, there is no strategy which is correct 100% of the time. So if I have to, normally we say go for diversification, select one waste fund on the basis of valuation. You have 20 options to select from, and select one fund on the basis of trend. You have on the one single fund, which is Edelweiss Balanced Advantage Fund. But just for argument's sake, if someone wants to know which strategy is better, no one is correct 100 out of 100, but relatively which is better, then the answer is simple. In all trending market, Edelweiss Balanced Advantage Fund will do better. In all non-trending market, valuation-based Balanced Advantage Fund will do better. And definition of trending is very simple. In all the year where Nifty has given you double-digit return, It can be 20, 30, 40% positive, which we normally call it as bullish trending market, or 15, 20, 30% negative, which we call it as bearish trending market. In both this kind of environment, we will tend to outperform. In a range-bound market, like we said of last 1 year, returns are 5%, 4%, 3%. In a range-bound market or in a year where Nifty is giving you single-digit return, normally Edelweiss Balanced Advantage Fund will underperform the category. But when markets are range-bound, returns of Nifty is 4%, 5%, 6%. A good fund and a bad fund, or an outperforming fund and an underperforming fund will not have a gap of more than 2, 3, 4%. Like if you have seen the slide in the beginning, our 1 year underperformance compared to the category average is 2%. But in a trending year like COVID, when Nifty gave you 15% return, there were funds on the basis of valuation which gave you 11% return, and there were funds where trend-based models were used, we delivered 23% return. So gap of almost 12% in a single year. So first, Indian markets are high beta market. It will be trending majority of the time. If I look at calendar year returns for last 20 years, 14 times Nifty has delivered double-digit return. 12 times double-digit positive, which we call it as bull market. Twice double-digit negative, which we call it as bear market. So 70% or 14 out of last 20 years, markets were suitable to our style. Only 6 out of last 20 years, markets have been range-bound, where our model would have underperformed. And 1 out of that 6 year was last year. But as I said, probability is in our favor. Even after that, we say go for diversification. You can select one fund from the value and one single fund available in trend as your choice.
So clearly, if you're getting into a balanced advantage fund category, choose 2 funds. One is a trending fund or trend-based model fund, and one is a valuation-based fund. Niranjan, we saw a lot of questions around international funds, and we've got a entire bunch of them, 6 of them covering Europe, ASEAN, emerging markets, etc. But let's focus on the 2 big ones where we see the most amount of interest. One is the Greater China Fund, and the other one is the US Technology Fund. What are your thoughts around both of them? And what do you think investors should do? Should they invest in them right now, or what should they do?
Sure, thanks, Varun. Yes, I agree. There were a lot of questions specifically on international funds. So let me cover one by one. On China, so if you see, last 5 years, China has underperformed all major markets. But this was not the case right until 2021. China was probably one of the best performing market after US and along with India. So what changed in last 2-3 years? 2-3 triggers. One, definitely the way government reacted to a lot of tech companies or many other companies, which was quite negative for investor sentiments. That took a hit. The second, China, which was immune to all the issues around pandemic, went into pandemic after 2021 when the entire other side of the world was recovering. That was the second trigger. And because of this too, the real estate market of China also went into a downturn, which contributes a large portion of its economy, almost 14-15%, which in any other country like India contributes not more than 6-7%. Over and above that, in last 1-2 years, we have also seen trade tensions between US and China, which is visible all around. So these were the 4 reasons why China started underperforming, and in last 3 years, it has underperformed. In last 6 months, though, things have improved. The Chinese government, first and foremost, has accepted that they need to do something for the economy, and the couple of reforms that they did, whether it is CRR cut, whether it is giving more accessibility to loans, whether it is tuning rightly the property market, boosting demand. I think so these are working fine. If you look at some of the data points in the recent 1 or 3 months, the consumer durable segment is doing well. It is the first green shoots usually in an economy, which shows that sentiments are improving, the domestic consumption is improving. As far as US and China trade tension are concerned, it will be ongoing, but the reliance on manufacturing for China has actually come down over the last couple of years, and the story is more on the consumption side, because like India, China is also a huge consumption market, right? It also has a 130, 140 crore population, which is, seeing their incomes rise. So all in all, in nutshell, I think so last 3 years were a kind of back-to-back bad news for the economy, for the, many other sectors in China, which has changed. In last 6 months, there have been a lot of green shoots, and in fact, we have seen a sharp recovery in Chinese market. Even after that, today China is one of the cheapest market if you compare to any other major economies. And that I think so gives a lot of margin of safety for equity investors in China today. So for long-term investors, I think so there is merit to stay invested in China. However, if you can't handle the volatility and you've been invested in last 2-3 years, there could be a case for you to redeem and invest maybe in domestic market or maybe US market, because China will be a volatile market. So if you are ready for that volatility and can stay invested for next 3 to 5 years, then definitely you can stay invested. Coming back to US tech specifically, now if you see US market in last 5 years or so, or maybe let's go back to 10 years, a large part of US market's earning, almost more than 50% of that earning has come from technology stocks. If you look at the return composition of US market, in last 10 years, US market has been one of the best performing markets. If you see the return composition, again, more than 50-60% returns have been generated by tech companies. It could be, the Max 7 but the bunch of tech companies has driven the entire rally in US equity. And that is also the reason why valuations are slightly on a higher side. But if you ask me, are the valuations near when they were maybe during dot-com bubble? The answer is clearly no, because dot-com bubble was something very different where, the price to earning was not to earning, but price to hope. But today, all these companies, you take, I can't name the companies, but if you take any companies, their earnings growth are still projected to be growing at double digit or even more than that. US is also, and specifically tech is also one space where the return on equity is highest today, almost 17 to 18%, which no other market except India is giving you. So with that, I think so having tech in your portfolio is basically a trade of a decade or rather a century. But as I said, for China, even US tech, there will be volatility. You have to stay the course. The best way to invest in tech today, or US tech specifically, is via SIP. If you have an existing investor, whenever there is opportunity, you can top up. Specifically, next 6 months to 1 year, there could be a lot of volatility given all the news around what's happening in US. However, most of these tech companies generate their income and profitability by trading across the globe. So once I think so thus settles down around the trade tensions and US economy, I think so tech stock is something that you need to have in your portfolios.
And we can come back to any specific questions that you have on these offshore funds during the Q&A in a bit. Let me head back to you, Bharat. Now, we've got a lot of these factor funds that we've launched across passive and active strategies in the last 3-4 years, but our oldest one has been a large cap fund, which uses some factors to make the portfolio. And we have the business cycle fund, which is recently launched, and the momentum strategies that we have across the passive fund basket. How are they different, and how do you really run them? And if you can just talk about what the process around that is.
Okay, so the advantage of factor investing is that you can make tailor-made solutions. And you rightly said large cap fund, if you look at it, the way we thought about large cap fund is that we want a fund where we are participating in the India growth story, and we wanted to participate in quality companies, which is the larger names to that extent. So the factor which we selected in our portfolio in the large cap scheme were more growth oriented at a reasonable price and quality oriented at a reasonable price. So those are the two factors which we used to create the portfolio for large cap. As I said, we can create different set of portfolios, different set of problem solution statements we can solve through factor investing. One of the problem statement we try to solve it in the balance advantage fund is using momentum as a methodology to actually move from asset classes. Whether equity is good or not so good in the market, you use momentum as a methodology to select equity. Similarly, in business cycle fund, we use momentum as a methodology to select sectors in terms of which sectors we need to be overloaded at this juncture to that extent. So you're using factors to identifying what works well to that extent. And if you look at it, the way we run these portfolios is we create, in a business cycle fund, we use all these three factors, growth, value, quality, along with momentum, where momentum decide which factors, which sectors which will be overweight in the portfolio. So the momentum in last 1 year has been a bit patchy. Consequently, you would have seen a lot of sector rotation happening in last 1 year, which has resulted in some of the underperformance in the business cycle fund. But when we look at long-term track records and how momentum has been in the factor, and when we test these funds, we generally look at long-term track records of all these factors. We see momentum as a great factor in a long-term perspective, and when we add this momentum as a factor in a business cycle fund, it solves the problem of how to move from one sector to other sector very well, along with a great set of returns over longer 3 to 5 year perspective.
So Bhavesh, just another question leading into our business cycle fund. We've seen some short-term performance, and during all our testing of the product, we've seen that the long-term returns are fantastic. Now, should this short-term underperformance scare investors, or they should stick with it, or probably add more and take that view that, hey, it's a great long-term product? And what are your analysis, plus what is the testing telling you?
Sure. So, as I started at the beginning, this was our biggest NFO, and the main reason for the success of the NFO was the backtested number which we showed. On a 5-year basis, the strategy delivered around 5% outperformance compared to NSE 500 without a single day of underperformance. But when we brought it into the live environment, I'm sure last 3 months, last 6 months, if you exclude last 3 months, performance was really very tough. But when we did that backtesting on a 5-year basis, the strategy has not even once have underperformed the benchmark. On a 3-year, it has underperformed the benchmark 5% of the time. On a 1-year, rolling 1-year return basis, the strategy has underperformed the benchmark 20% of the time. But on a 3-month and a 6-month basis, the strategy has underperformed the benchmark 35% of the time. So because during NFO we were more focused on 3-year and 5-year performance, it was like 95 to 100% of the time we were outperforming. But in real environment, on a 3-month and 6-month basis, the performance as its historical track record was underperforming almost 35% of the time. So when we launch our fund from July till February, our NAV of business cycle fund from 10 rupees corrected to almost 7.5, underperforming the benchmark by almost 12.5%. But as we said in all our, you can say, previous data, previous slides also, momentum over a long period is the best performing factor. And the best way to play recovery in any market is through a momentum-based strategy. That is where when you look at last 3-month return, NAV from 7.5 as we speak today is already at 9. So 20% in last 3 months compared to 17% returns by benchmark. So we have recovered, you can say, close to 3% underperformance. I'm 100% agree that even now it is not a great performance because now the underperformance is still at 9.5%. But if you look at historical return, 100% of the time, whenever you had a quarter or a 6-month period of underperformance and you stayed invested for next 12 months, irrespective whether we entered into a bull market, a bear market or a sideways market, we have seen recovery on all the occasions. And that is something which we are confident about. Factor investing, momentum investing is something what we are doing over last 15, 16 years across different fund. And each and every fund of our, you can say AMC, which are on the basis of factor, have seen 3 months, 6 months, 1 year of underperformance. But when you look at 3-year, 5-year performance, you have seen in the slides, most of the funds have 100% of the time outperformed the category average. So we are very much confident on this style. And as I said, it is not only momentum which can have a 6-month or 1 year of underperformance. When value was underperforming, value underperformed for 4 years from 2017 to 2020. Last 3 years, quality is underperforming. 2013 to 2016, during taper tantrum and demonetization, growth as a strategy underperformed for 4 years. So each and every style, whether it is growth, quality, value, will have their underperforming period, and that we have seen historically is anywhere between 3 to 4 years. But momentum historically for last 15 years have never underperformed for more than 12 months. So we are almost completing 12 months of our launch. So I think we are almost at the fag end of the, you can say, the pain period. We have already seen a great recovery over last 3 months, but yet a lot of distance is yet to be covered. But as I said, the best way to play recovery in any market is a momentum-based strategy, whether it is our business cycle fund or any other momentum-based fund, which are available both on active and passive platform. So we are very much confident, and I'm sure we expect all our investors also to support us in this. You have invested in this product with a 3 to 5 year horizon. We have just completed 11 months, yet to complete our first year. We have already seen early sign of recovery, and if you stay invested for the course of 3 to 5 years, I'm sure you will not get disappointment in any of these products where momentum is used aggressively.
So for the last 1.5 hours, we've spoken about outperformance, underperformance, and all of these terms. As investors, I know everyone is evaluating funds on a daily basis. Media has been evaluating funds on the news channels on daily basis. But Radhika, as an AMC CEO, how do you evaluate fund managers, and how do you decide that, hey, this guy is doing well or not?
No, so I think as we come to the end of this day, and I think investors have been extraordinarily patient because we've covered so many funds and so much content. But before I answer that, I think one of the reasons we do this meet is that both for the online audience and the offline audience, transparency and communication is important to us. And you know, all funds go through performance ups and downs, but the important thing is that, you know, particularly in the equity funds, when we look at them over 3 years, 5 years, are they able to beat the benchmark? Are they able to do relatively, you know, in the top half of their peer group? I would say quartile 1, quartile 2 in the long term. That's really what we are looking for. So we, of course, evaluate the fund managers on process. Are they following the process that they say that they are following? So if Tradeep is saying no cash calls, then indeed it has to be no cash calls. So one, are you evaluating the process? Because I think that is our constitution and that is our guardrail. Then, of course, numbers are important. So we like to look at performance. We like to look at it over a 1 year period because, you know, all of you ask questions about the short term. But we also like to look at it over a 3 year period. And we think 1 year and 3 year blends the impact of long term, but also not falling asleep in the short term. And we constantly look at this rolling returns data that we present. And third, we look at risk and how the risk metrics of our fund shape up. Our board does quarterly reviews of our funds and risk metrics. And I think this constant, every single fund that is managed in Edelweiss AMC, no matter how small it is, it could be a 10 crore fund, it could be a 10,000 crore fund, goes through a process of quarterly review and a monthly IC and risk committee.
Thanks, Radhika. So one last question from on the panel today before we open it up to all of you for your questions. Niranjan, everyone in India wants to know about gold and silver. So our view on that, and if somebody is really bullish on gold or silver or both of them, how can they invest?
Right. Thanks, Varun. I think so, like any other asset class, gold is shining and having its, great time. 2-3 reasons why gold is been doing really well. In a volatile world, we have always seen gold doing well. But today, specifically, what is happening, there is a lot of talks about de-dollarization. People want a safe haven away from US dollar. And that's what we have seen. Central banks globally, including India and many other emerging countries, have loaded up on gold. That is one reason why gold has been doing well. Second, gold also underperformed a lot. If you see gold to equity ratio, it underperformed a lot during pre-COVID, and it's broadly a catch-up because every asset class which has underperformed tend to do a catch-up. The law of averages plays in. So these are 2-3 reasons why gold is doing well, and it may continue to do well till the time market is, the geopolitical issues are there. But having said that, I think so a significant part of rally in gold we would have seen. I remember from $2,200 an ounce to almost $3,400. I think so the rally has been significant. So chasing for another maybe 50%, 100%, that may not be the case in gold. Having said that, silver on the other side has underperformed a lot. Usually, historically, we have seen whenever gold has done well, silver has actually done extremely well. But this time, because of trade issues, and silver is one commodity which is linked to a lot of semiconductors. It is used in solar, electric vehicles, and because there could be some disruption into trade, it didn't do well compared to gold. I think so silver can do a good catch up. So maybe a better approach today could be balancing your exposure evenly to maybe gold and silver together and have them in your portfolio. Gold is again in asset allocation parlance, it helps you cushion volatile times. So have it as a cushion and not as a booster to your portfolio return. If you have it with that objective in your portfolio, I think so gold will still hold or would shine in your portfolios.
And how do you invest in them through Edelweiss?
Oh, well, so we have a unique offering which is Edelweiss Gold and Silver Fund of Fund. And what we have done is to give equal exposure to both these asset class. We have tried to maintain 50% allocation in both gold ETFs and silver in this fund. So this through one fund you get allocation to both gold and silver ETF in a much more tax efficient way, and it self rebalances the portfolio whenever one outperforms the other, and it's probably a seamless way to take exposure to both the asset class today.
Fantastic. Can we have mics for the audience and your questions, please?
We have the question.
So good evening, everyone. So actually, I have two questions. One is for Radhika ma'am, and one is for Bharat and Bhavesh sir. If I can ask, 1 second. As the time is shifting from simple investing to factor-based index, so in future will we able to see this factor-based index replacing a traditional index? Like we see a lot of ads कि पहले कोई इन्वेस्टर पूछता था कि किस में इन्वेस्ट करो तो बोलते थे कि निफ्टी में इन्वेस्ट कर, इंडिया बढ़ेगा तो तेरा पोर्टफोलियो भी बढ़ेगा. बट इन फ्यूचर विल बी एबल टू सी दिस फैक्टर बेस्ड इंडेक्स इज रिप्लेसिंग दिस ट्रेडिशनल इंडेक्स. एंड second one is for Radhika ma'am. As you have earlier mentioned, कि हमें 2 या 3 कैटेगरी के ही फंड्स हमारे पोर्टफोलियो में चाहिए. सो एक कैटेगरी के अंदर भी देयर आर लॉट्स ऑफ 44 to 45 फंड्स अवेलेबल इन द मार्केट. सो एज अ यंग इन्वेस्टर्स, हाउ वी सिलेक्ट द फंड्स? I'll give you an example. Like while selecting stocks, we see some ratios, PE, PB ratios. In mutual fund, we have also some ratios like alpha, beta, and PE, PB as well. So how we can select a fund in same category? So that is the question.
So I think short answer to the second question, and then I'll give a quick take on the first question. Of course, Bhavesh can add. So short answer is, when you pick a stock, you see management. I think you see the management of the fund house and whether you're comfortable with them. Then I think when you pick a stock, you look at business. The analogy in picking a fund is you look at what the investment style is. कब fund अच्छा करेगा, कब नहीं अच्छा करेगा. They spoke about value, growth, momentum. What really is the style? Because finally, if you're picking 2 large cap funds, you don't want 2 identical large cap funds. You want people who are running funds differently. And third is, I think when you look at an investment in a stock, you look at numbers. Now, the number I like to look at is, when I am looking at funds, 5-year rolling performance of the fund. What happens in the worst case? What happens in the best case? What happens in the average case? And does it do better than the benchmark? And does it broadly do at least in the top half of the peer group? So management, what the person is actually doing in terms of investment process, and returns. I think long-term 5-year rolling returns, to me this is a very simple answer to the question. My quick take on this replacement is, see, my belief is that as India evolves, you will have lots more investment styles. Factor, fundamental, fixed income, you will have platforms, you will have SIF, you will have passives. I don't think actually one will replace the other, but people will make space for new ideas. And I think your challenge is, and as investors, it's good to start learning that there are different styles, things that do well at different times, and then you figure out what to place in your portfolio.
Yeah, and see, as investor matures, then they will not be coming to a fund manager for market returns. They will be coming for their specific requirement. If I am already loaded on equity and I feel that in short term there can be a big spike in market, I want to invest only in momentum stock. Then he will not come and take all 50 stocks of Nifty. He will take only the momentum basket. Similarly, he is worried about geopolitical situation. He just want to buy quality company. Within Nifty also, some companies will be there which doesn't have great ROE or they are not great on quality parameter. So he will not take Nifty 50 as the market. He will go and select quality 50 as the basket. So as more and more, you can say, maturity comes into the market becomes developed, generating alpha becomes a challenge. That is where you will see this passive index or factor-based index becoming more and more popular.
In short, we should stick to the basics.
Yes.
Thank you. Thank you.
My question is for the Radhika ma'am. In your presentations of the various funds, we did not find any mention about the defense sector. So can you just give a perspective and what do you think? Because this is a sector which has done well for the last few months. But I mean, just your opinion.
So, look, we have had positive views on defense in multiple funds at multiple points in time. If you look at Edelweiss mid-cap fund, flexi-cap fund, large and mid-cap fund, there have been various points, including today, where we have had exposure to defense. Now, Tradeep may have not called it out, but we have. So, if you ask me structurally, are we excited about defense as a theme? Absolutely. We believe that indigenization is a story. I think what we have to be careful of is valuations. So in aggregate in the regular funds, we are overweight defense, if anything. We've moderated that view up and down depending on valuations. Where we have yet not launched a product is a full-fledged defense fund. And I think never say never. But that is a function of the fact that we wanted that if we are going to launch a dedicated fund on this, one, we should launch it at the right point in the cycle when it's not very expensive. Secondly, the universe of defense stocks has to be wide enough for us to justify a fund. So that's my quick take. Niranjan, you wanted to add something? No. Yeah. There's a question there and there. Yeah. There.
Can you hear me okay? Yeah, thank you so much for having us. This is my first meet to join, but I think seems like it could be one of the first, but will continue forever. Thank you for increasing the number of products over the years that we have seen. I've been an avid investor in Edelweiss for the last 5 years.
Thank
Congratulations on expansion. One of the things that drove me here is about the fixed income solutions where I'm looking at REIT and INVIT as an aspect. And that's where I think I need some help on this panel to say, if I were to choose the Edelweiss platform and continue building upon the fixed income solutions through REIT and INVIT, what would be your take on that and advice to me? And then I'll put my second question through after you answer the first.
Yeah, I mean, Bharat, you want to take, so we invest quickly and Bharat can add. We invest in REITs and InvITs. In some of our funds, hybrid funds, and Bharat can talk about that. Note, we all as mutual funds have a SEBI limit on the exposure we can take to this category. SEBI is currently examining the increase in limits because of the liquidity. Yeah. When we have funds in the SIF, perhaps these numbers and exposure may increase because regulatory limits will increase.
Great. On InvITs and REITs, if you look at it, the number of companies which are already listed is in few numbers, 10, 12, 13 numbers are there in the market. On a mutual fund platform, one of the problems what we face on InvITs and REITs is the liquidity is pretty poor. When we are buying, there is a lot of impact cost. While selling, there is an impact cost. To build positions in the InvITs and REIT space is very hard on a mutual fund platform to that extent. A buy and sell, buy and hold approach is possible sometimes when you launch a dedicated fund where the investor expectation matches with the asset class expectations. Currently, what we are doing in a very small format in terms of, however, we are seeing wherever the yields are better off in InvITs and REIT, we are taking some exposure in hybrid category. On and whole, if you look at InvITs and REITs, it's an interesting asset class. It's a blend between debt and equity. It gives you a flexibility of the debt, which says that you can have a streamline of cash flows, but it will have some upside, which is an equity as a asset class, which can offer in terms of better rental yields, better the traffic growth, and so on and so forth. So that's an interesting class. It's still to develop in India. SEBI is doing it. Radhika ma'am spoke about it in terms of the steps which SEBI is saying in terms of growth of this asset class. Hopefully in next 3-5 years, we would see a dedicated fund also which invests in REITs and InvITs, which would be another asset class, another opportunity for you investors to actually evaluate.
We'll take one last question, and I'll request you if you can just take your question offline, because all the panelists are going to be here, so you can just ask questions to them once this is done. Your question, sir.
My only question was regarding debt mutual funds and tax planning. So let's say my parents are retired, so I want to invest in April and take the profits in March. So what would you recommend, like a floating rate, dynamic bond fund, credit risk fund? What would be an ideal fund for that kind of a time frame?
So debt funds, if, as you said, parents, I'm sure they won't be paying any tax as per the tax slab, and debt funds makes sense for them. Looking at the current rate cycle where we are, I think so a mix of a low duration fund and a short duration fund would make sense. For tax management, as you said, you want to book profits and then next year again. So if you book profits, assuming they don't pay any, they don't have any income, up to 12.75 lakh, there is no tax, right? As per the new tax regime. So gains up to that, even from debt mutual funds, are tax free today. So accordingly, you can plan it. You can book those gains via SWPs and all. And then again next year. So probably an investment in a low duration and a short term fund with SWPs spanning 12 months in a year would make sense.
Let's just take one last question and then close this out.
Yeah, good evening. Let's say I have an ongoing SIP in a flexi cap fund, a momentum mid cap 50 fund, and a small cap fund. If today I want to deploy some lump sum cash in either of these funds, which should be my preference, knowing the current market? So considering that momentum funds have been slightly lackluster in the last one year or so.
So if you've gone through what we had to speak about, one thing really came to the fore, that this year is going to be a very volatile year. If you think you've seen a lot of volatility, that's settling down, but it's not ending. And in a year like this, of the funds that you mentioned, you want to be in a product that is a little less on that risk profile and little less volatile as well. So out of those products, we think our flexi cap fund is a great solution, because what it does is it has the flexibility to move between large, mid and small. Currently, given where we are in the market cycle, the portfolio is about 65% positioned into large caps and the rest is into mid caps. But as the market cycle progresses and the earnings start coming through, we'd probably change those positions and become a little more aggressive. So it is a little defensive today, but we'll change stance. So simple answer, go to the flexi cap fund.
So the SIPs continues, and if I have to deploy lump sum, flexi cap should be.
That's correct.
All right. Thank you so much.
Thank you so much, and thank you so much for coming through. All the panelists are here after the session, and you can ask them questions one-on-one. Thank you.